Hi, this is Ron Cipcic, and in this video we're going to take a look at the U.S. government's accounting system for the U.S. economy. This accounting system is actually called the National Income and Product Accounts. Like a business, our government wants to keep track of the economy. You can think of the economy, the U.S. economy, as a business. Now this offends some people, but let's just draw the analogy, at least to get the idea here, that the U.S. economy, we'll call it U.S. Incorporated, takes inputs, resources, and produces what? Produces outputs. Now, if you think of a company like the Kellogg Company, for instance, the Kellogg Company produces cereal, which is its output, and takes a variety of inputs to produce that cereal. Well, the Kellogg Company, for several reasons, has an accounting department. They have an accounting function within their corporation that allows them to keep track of how the company is doing. There are internal stakeholders who would like to know how well Kellogg is doing. For instance, the shareholders, the owners, they need to know how well the company is doing. Whether the company is doing well or not will affect whether they want to hold Kellogg stock. The managers, again, internal stakeholders, certainly have a very, very, very important interest in knowing how the company is doing, not just annually, but quarterly, even monthly, sometimes even weekly or daily. So the managers of a corporation need accounting information, and you've got the government. Frankly, the government is very interested in how the Kellogg Corporation is doing annually, because the government is interested in taxing the Kellogg Corporation on the basis of its profits. And so whether you're talking about shareholders, or you're talking about managers, or whether you're talking about the government, these different entities have an interest in knowing how Kellogg's is performing. Well, the same ideas apply to a macroeconomy. The macroeconomy, we're interested in the performance of the macroeconomy, how well it's doing, not just annually, but quarterly and monthly and sometimes even weekly. And so you can imagine there are federal policymakers, the president, who has some influence over the economy, not much, but some. But you have Congress, who has the constitutional authority to spend money and to raise taxes. So you can think of the federal government, the executive branch, the legislative branch, having a very strong interest in knowing how the economy is doing. Well, the fact is that we have a very, 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 very large and sophisticated data collection system, economic data collection system for the U.S. economy. And this data collection system provides information to Congress and the President and to other agencies that are responsible for helping carry out important government functions in the U.S. economy. And moreover, this data is shared with business people and other interested parties, academics, who are interested in studying the U.S. economy. So the National Income and Product Accounts are a very, very important accounting structure that the government uses for measuring the performance of the U.S. system. Now let me scroll this down a little bit and we'll dive right in. We've already covered some of the National Income and National Income and Products accounts when we did the GDP-Complex Circular Flow model in one of the earlier videos. So you'll recall that in that video we took consumption expenditures plus actual investment expenditures plus government purchases plus exports, subtracted imports, and we said that that is equal to, that's an estimate of GDP. Now these are product accounts. These are product accounts. Product accounts. And these are different categories of products. So we've got products that households buy, products that businesses buy, products that governments buy or make. We've got products that foreigners buy, and we also keep a category of the products that we import, remembering that we subtract imports because imports represent the value of products that, say, U.S. citizens purchased but that were not made in the domestic economy. So one way to get to GDP is what we call the expenditure approach. And this is the expenditure approach. Now you can imagine that there are literally millions and millions of people involved, as well as there are billions and billions of dollars spent in tabulating the total consumption of all U.S. households, the investment rates of U.S. businesses, all of the spending and economic activity of governmental units, not only federal, state, and local, and also people involved with measuring exports versus imports. So again, millions and millions of people involved and billions of dollars being spent tabulating this data. Now, we know from our simple circular flow analysis, and we did a video on simple circular flow and GDP earlier, but we learned that there are basically two approaches to measuring GDP. One approach is the expenditure approach, but there's a second approach, and that is add up the incomes. In other words, you can value the output either on the basis of what people spent on it, and that's what we've done here, or you can add up the total incomes paid, and you can infer that this is what businesses paid out to make that output. Now, in a simple circular flow world, GDP measured the expenditure approach. GDP measured the expenditure approach would equal national income. National income being our measure, our most aggregate measure of income. So in a simple circular flow world, that's the case. But in a complex circular flow world, we'll actually learn that GDP does not equal national income, that in fact, if we use the expenditure approach to calculate GDP, we'll get a number, whoops, sorry about that, I should not have put an equal sign in there. Let me get rid of that with my eraser. So let's get rid of that. And that GDP is actually greater than national income. And this is a small adjustment. It's actually a couple factors dictate this or lead to the derivation of this. But nevertheless, we need to acknowledge that GDP, while theoretically GDP should equal national income, in practice GDP measured via the expenditure approach is going to be greater than national income. Now, before I actually show you this adjustment, show you why, before I actually show you why GDP is greater than national income, let's make sure that we know what national income actually is. So again, let me move my frame down a little bit here, and we'll be ready to go. So how do you calculate national income? Well, national income is relatively simple to calculate. If you take the compensation paid to workers, which we have up to this point have been calling wages, but if you take compensation, you add it to rental income, you add it to interest income, let me rewrite that, interest income, and you add to that two types of profit really, proprietors' profit or income. A proprietorship in the business world is an unincorporated business. So if you study the legalities of business ownership, you'll see there are actually proprietorships, partnerships, and corporations. But in this data, we just put proprietorships and partnerships where there's more than one proprietor. We put those under one category, proprietors' profit. So the key idea here is unincorporated, and then add to that corporate profits, corporate profit. So if you add together those categories, which we've talked about wages, we've talked about rent, we've talked about interest, and we've talked about profit being the four basic types of resource payments, as well as the four basic types of income. So if you add those together, you get something called national income. National income. Now, again, in theory, GDP measured the expenditure approach, C plus IA plus G plus X minus M. In theory, GDP should equal national income, but in practice, they don't equal. Now, let me quickly, I want to actually show you why. And this is going to lead us into connecting the product accounts to the income accounts. Okay, so again, let's write on our sheet here, C plus I, A, plus G, plus X minus M equals GDP. If you take GDP and you subtract depreciation allowances, now if you looked at my earlier video on the complex circular flow, I talked about depreciation allowances, and depreciation allowances is really a type of business saving. Okay, so this is depreciation allowances. This is businesses saving to replace worn out capital. If you subtract from GDP depreciation allowances, you'll get actually a number equal to national income. So there are effectively two ways to get to national income. You could actually go at it directly by adding up compensation, rental income, interest income, and the profit income. Or you could go at it indirectly by taking the GDP number you calculate using expenditures, subtracting depreciation allowances, and you get national income. Or, if you think about it, you could get to GDP by taking national income and adding back depreciation allowances. So you should be very comfortable with this relationship between GDP and national income. I can take GDP minus depreciation allowances to get national income, or I can take national income and add back depreciation allowances to get GDP. All right, now national income, again, is, as far as we're concerned, the broadest measure of income at the macro level. But there are other levels of income that are of interest to the government and to business people and to academics. And so let's go ahead and continue on here. Now I'm going to move this up a little bit. I'm going to have to keep doing this because we're actually going to have a fairly long list of items here. If you take national income and subtract, go back to black here. Let me erase that very quickly. And if you take national income and subtract, there we go. And I'm sorry, I'm having a little technical difficulty here, but we are getting right back on the mark. And subtract indirect business taxes. This is indirect business taxes. These are like sales taxes, excise taxes. You subtract corporate income taxes. You subtract corporate Social Security taxes. Corporations contribute to the Social Security program. If you subtract retained earnings, again, this is retained earnings. If you watched one of my earlier videos, you learned that retained earnings is actually a type of business saving. So you subtract these three business taxes. You subtract the two types of business saving, depreciation allowances and retained earnings, and then you add back in government transfers. You get something called personal income. Now, personal income is what actually flows into households. Now let's think about this. Let's think about this. we look at the complex circular flow, we see that GDP is basically the flow that flows into the business sector. But if you subtract out of that flow any business saving, depreciation allowances, and any retained earnings, and you subtract out the taxes businesses pay, you're going to have the funds that are left over and that are available and can be sent down to households. But remember, not only does money come from the business sector, but it comes from the government sector into the household sector. In other words, governments give money back to households, so you have to add that back in. Now, if you take personal income and subtract personal taxes, so this is personal taxes, you're going to get something called disposable income. Disposable income. Disposable income is what households have available to either spend or save. Let me again move this up a little bit so we can finish this. Try to keep as much of it as I can keep in the picture. So disposable income is after tax income. Personal income is before tax income. So when I get paid as a professor, I have gross pay. Gross pay is before taxes are withheld. And my net pay is what I get after taxes are withheld. Out of my net pay, my disposable income, what can I do? Well, I can save. So let's say there's saving by households. And let's put these all in parentheses to stay consistent. And what's left over is C. What's C? C is consumption. Notice the model began way up here with consumption, and the model ends down here with consumption. In other words, we've gone around the complex circular flow. I'm actually going to show this to you very quickly. So we started with consumption and we end with consumption. And in essence, we've gone all the way around the complex circular flow. Now, this vertical column of items these are called the income accounts. So what we're doing is we're taking GDP and we're actually breaking it down in the three different levels of income. National income, which is the broadest measure of income. Personal income, which is what actually flows into households. Disposable income, which is what households actually have available to either spend or save. Now, I'm going to do a very quick exercise here. I'm actually going to take these income, and product accounts, and I'm going to tie them to the complex circular flow model. And I'm going to actually show you a picture of how this works. Now I'm going to move this over a little bit, and I'm going to put in, let me not use that color. You can see I'm very proficient with my erasing tool. It's taking me quite a few videos though to get proficient with that. Okay, back to our regular program. That was a commercial break. Okay, so we've got our business sector. We've got our household sector. And we have a little credit market here. We have our government sector. And up here we have our what? We have our foreign sector, don't we? Now this picture is going to be, I'm going to warn you beforehand, this is going to be a lot of stuff crammed into a little space. But I want to just walk you through this, and I'll show you how all this connects. By the way, you can do this at home. Don't be afraid. This is something you can not just watch, but you can do at home. I hope you're taking notes over this. So let me put in the product side first. I'll use green for the product side. So if I take CD plus ID plus GD plus X, what do we get? We get GDP. Yeah. Remember what we did up here. We can actually, by subtracting M, what we're actually left with up here is CD plus ID plus GD plus X. Remember that when we subtract M, we pull out the CF, IF, and GF, and I showed that in an earlier video, so I don't have time to keep going through it. So GDP can actually be shown over here. Okay? Now, if you subtract, let me go to a different color here. If you subtract out depreciation allowances, here's business taxes. If you subtract out indirect business taxes, so I'm going right down the list now. Depreciation allowances, indirect business taxes. If you subtract out corporate income taxes, it's a business tax. If you subtract out corporate Social Security taxes, that's a tax. Notice those three taxes right there, business taxes. If you subtract out retained earnings, what have you done? You've actually taken GDP, which is what basically flows into the business sector, and you've taken out all the business saving, you've taken out all the business taxes. What's left over can flow down to where? Households. Now remember, government also provides transfers to households. Now remember what a transfer is. A transfer is a what? It's a negative tax. Notice we subtracted all the taxes here. So if this is a negative of a negative, it's a what? It's a positive. So the only item that is going to have a plus here is going to be government transfers. Okay, in terms of these movement down the income side. So GDP minus depreciation allowances, minus indirect business taxes, minus corporate income taxes, minus corporate Social Security taxes, minus retained earnings, plus government transfers equals personal income. The only income figure you can see on the circular flow, complex circular flow, is personal income. You cannot see national income, and you cannot see disposable income, at least the way I have the model configured. Now, households receive their personal income, and what do? They pay personal taxes. To whom? The government. But household, and then what's left over is disposable income. So let me check these off. So again, we checked off government transfers, personal income. We check off personal taxes. Now we're down to disposable income. But households also save. So minus saving by households. And what's left over? What's left over is C. So where did we start? We started with C. Where did we end? We ended with C. So the upper side, let me go back to a different color here. The upper side of the circular flow looks at what? The product side. So this upper side is the product side. What I call the belly of the model, the underside of the model, is the income side. All right. That concludes our analysis and review of the national income and product accounts. Not only have we laid those accounts out, but we have tied them to the complex circular flow model. That was quite a job.